Mike, do you think China wants to become the new reserve currency? Like,
Oh,
if they?
there's been a lot of mentions of that, and one thing that's so significant to point out is that obviously Trump and Xi are still going at it and trying to come to terms. But let's just remember what really started my major bullishness on gold was the unlimited friendship, and now we're having that issue with China being a decisive enabler of this war. I'm surprised it's not brought up more, but by the way, yes, they are, according to NATO, and they're number one buyer of Russian oil now. So they're trying to take Russian oil off the market with sanction anything. Well, that means China is just going to be the main buyer. Just not going to happen overnight. Potential clandestinely.
Global markets are shifting into a new phase of uncertainty, where trust, inflation, and power are colliding in ways not seen in decades. The world is witnessing an economic tug-of-war between the United States and China, one that's quietly reshaping global finance. While the U.S. economy carries record debt levels beyond $38 trillion, questions about the reliability of official economic data have deepened. Inflation appears subdued on paper, but fiscal spending remains out of control, eroding confidence in the dollar as the world's reserve currency. Meanwhile, China's expanding trade dominance, cheap energy flows from Russia, and its growing role in gold accumulation are signaling a global transition away from dollar dependence. Gareth Soloway, a seasoned technical analyst, and MikeMcGlone, senior macro strategist at Bloomberg Intelligence, warn that the next stage of this shift is already unfolding. They point to the weakening trust in U.S. financial reporting and the illusion of restrictive policy, while liquidity floods the system. As deficits run near 7% of GDP, assets like gold, treasuries, and even Bitcoin are reflecting the cracks in this system. Gold's strength and the S&P to gold ratio's decline resemble the setup of the 1970s and 2008, moments before major financial resets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Mike, do you think China wants to become the new reserve currency? Like,
There's been a lot of mentions of that, and one thing that's so significant to point out is that obviously Trump and Xi are still going at it and trying to come to terms. But let's just remember what really started my major bullishness on gold was the unlimited friendship, and now we're having that issue with China being a decisive enabler of this war. I'm surprised it's not brought up more, but by the way, yes, they are, according to NATO, and they're number one buyer of Russian oil now. So they're trying to take Russian oil off the market with sanction anything. Well, that means China is just going to be the main buyer. Just not going to happen overnight. Potential clandestinely. So this is a Cold War that's heating up, and it's just economic. But sure, the thing is, that's one thing that I love about cryptos is every single country in the world, particularly our adversaries, look over at cryptos and their eyes are light up like, oh my gosh, what are we going to do about this? This space organically went to stable coins. Dollar as its base layer. The most enduring bull market, I'll point out forever, is in proliferation of stablecoins. The technology is amazing. They could have adopted the yuan, the yen, the euro, but they went for the buck. And so if you're in China, that's not a good sign. The global macro is so against them. And Trump tilting was great, but that's why I think in the macro it's so positive for the U.S. And Scott points out, as long as we don't mess it up.
I think so. CPI year over year is supposed to be 3.1%. I'm going to use my magic 8-ball thought process. I'm going to say it's going to come in at 3%, so one tenth better, and then I think 1/10 better on CPI month over month, so 0.3. And again, not to be, and we shouldn't be joking about it, but at the same time, it's you can't help but think, like, look at how they did with the jobs report. And that was when the government was open, right? When the jobs reports were, they had to redo almost a million jobs. I just don't know how much truth there is to any of this stuff, and I think it's more narrative driven now. Like, what's going to keep the party going on the stock market more than anything. So,
well, this key thing to remember about CPI and inflation metrics, and one thing for remind us is in PPI in China is running -3%, and their money supply is double the U.S. and their jet to GDP is triple the U.S. The key thing about it is when you start getting weaker in expected CPI, and everyone's a lagging measure, that's typically because of lack of demand pull. As long as the numbers aren't manipulated. But that's what's happening now is someone thinks that's somewhat subject. So one thing we've started here is a whole group of quants in our firm is finding the alternative data, scraping stuff off of Amazon and Walmart and stuff and trying to find alternative data. The whole world's doing that now. And we're going to depend a lot less on government data. And plus, also, it's less robust now that Trump made that point of firing the Bureau of Labor Statistics head when he didn't like the data. I mean, this is just, okay, well, we'll find something else. And if you can't trust U.S. data, that's a problem.
I agree. I agree. And that's my biggest concern is that it's everything that in terms of trust, right? You look at the dollar being the reserve currency of the world. And now the US just crossed $38 trillion in debt with no plan to even tackle it. And then, you throw in these type of things where allow the economic numbers, like, do we trust them? And essentially what that does is it slowly erodes the country's belief in the US system, and essentially de-dollarization is taking place. Now, long term for gold, for Bitcoin, that's probably a good thing, but it's certainly just, is this good for our economy to slowly not be viewed as the best of the best? And again, we still are, listen, and we'll still be for many years to come, but I do think it's a slow, slippery slope. We've been told by the Federal Reserve that their monetary policy is restrictive. Why is there so much money out there that can apparently make every asset that people are in go to all-time highs if we're in restrictive stance? And what is that? Are we, or is that like, what the heck? I know that's what I'm saying is like, that's what's so crazy about it, right? It's like, they're like, oh, we have to lower rates back. We're going to move back to like our neutral policy, which is whatever, 3% interest, whatever it is. But I'm like, okay, so you're telling me that what we've experienced now in the last year is restrictive?
So that's the thing. It's been, as we mentioned earlier, and you mentioned earlier, it's been offset by like enormous fiscal spending and tax cuts and everything. That's a wonderful thing to keep things going. Deficit spending running 6 to 7% GDP. That's part of what gold figured out. Part of what people thought would really help cryptos, but they're realizing, no, sorry, but this is more completely related to the stock market, that they might go up, and there's just too many of them now. And gold's not too expensive, so that's like I can tilt over the one chart that really scares me. And this is just the S&P 500 ounces of gold. Looks like it's rolling over. It's bounced on this support for a while. It was actually below it a few days ago, and the ratio is like 1.62. It was down to 1.55 recently. And if it just starts rolling over a little bit, it's very similar to what happened in the 70s and very similar to what happened in 2008. And this, the first time we ever got to this level was 1929. That's the big picture stuff. That's part of what kept me very bullish gold. But now gold's expensive. I just tilt back and say, maybe we'll get lucky. Maybe this isn't rolling over. And that's why I stick with treasuries and thank you. Just sometimes you're supposed to GMTFO, just get out of everything.
Markets are entering a fragile and deceptive calm. Volatility has fallen to multi-year lows, even as cracks beneath the surface widen. Gold, now stretched far above its 5-year moving average, mirrors conditions last seen in 1980 and 2011, both moments that preceded major inflection points. Traders who have ridden this rally are beginning to question how much further the momentum can carry before gravity takes hold. The next significant rotation, many believe, may already be forming in bonds, where early signs of a bottom hint at a new cycle of capital flows. Meanwhile, crude oil's decline toward the $40 range paints a deflationary picture that contrasts sharply with gold's resilience. The divergence between the two, the widest in nearly a century, underscores how distorted global markets have become. Stock valuations remain historically inflated relative to GDP, an imbalance that cannot persist indefinitely. With CPI still hovering above target and the Fed signaling rate cuts despite inflationary pressure, traders find themselves trapped between artificial liquidity and real-world weakness. Every asset's fate now hinges on one critical pillar: the U.S. stock market's ability to stay aloft. Should it falter, the dominoes of global finance may begin to fall. Let's get back to the interview.
This is a gold annual chart. You can take a 5-year moving average. It's the most extended above the 5-year moving average since 1980 on a year basis. Now, this is we end of the year basis. I love using candles sometimes because you get the sticks. Now, we've done it before. This is like 2011. You get a stick. Anytime you get near that level, you get a stick. Right now, we're through it. It's not a level you want to be overweight long. Testing shorts is for the more astute, maybe options traders. I don't do that anymore. But certainly, if you've been on this trade, you're supposed to say thank you. Nothing like GMTFO once in a while. Get me the heck out. And this is why I think we're tilting over to the next big trade, which is bonds. Now, this is, again, I mentioned this is why I started in the business, in this trading pit, trading U.S. Treasury bond futures. Is it finally bottoming? Maybe. I hope so. I think so. That, to me, is the next big trade. But I also overlay that what's really struck my attention for a while. You just look at Bitcoin versus gold cross. It's been not trending for. We're in the 4th year now. It's showing you there's a problem in this highly, liquid speculative asset. And also I point out one thing that's really changed since any single time in the past is this is 90-day volatility S&P 500. It's the lowest since 2020, actually since 2020. So yeah, we could stay low for longer, but you don't want to be getting short. And I pointed out before, and I also point out, I'll end with this one. The one thing I want to point out with crude oil is a deflating asset. We bounced so far this week. We're up to $61 a barrel because the low was 55 and it got too cheap. But this is an annual chart of crude oil. Again, look at the sticks. You get these tails, and we've had a tail this year. I still think it's going to 40. It's bottomed at 40 since 2008. And one key reason, I'll end with, everything to me is dependent on this. Is this the U.S. stock market cap to GDP at 2.3 times? Is the economy. It's the most important thing on everything you look at now. That has to stay elevated, or we just get a little of the dominoes. That's why I look at it. If this just ticks down a little bit, crude oil is easily going to 40. Ticks down a little bit.
On market to rally, that means rates are going lower. Is your hypothesis thinking that we're going to start to see a much more dovish Jerome Powell? Like, do you think he's going to show that dovishness in this next conference call or press conference next week, or are you thinking more in 2026?
So we'll see for sure. I think the Powell is going to cut at every meeting for now, at least for now, for this year. So we have a meeting in October. We're fully going to price 25 basis points of cuts. In December, they're going to cut another 25. You get a year from now. I always look a year forward, and Fed funds are supposed to be at 2.95, and right now they're just about 4%. So markets price that in. It's going to happen. Just question what might stop that. I know what might accelerate it, the stock market going down, but it's already priced in. We need that fuel. And no, we've seen this before, but this is the key thing now. We're in the midst of a government shutdown. We're not getting the data. We're not getting the trigger for people to do things, but it's also a very economically repressive situation to be shutting down the government. I'm just hearing some of the anecdotal data about jobs being, like in Chicago, there's just hiring is just collapsing. The Beige Book came out recently from the Fed, and it's showing, now we've seen this before, but that's the bottom line. None of that really matters until this right here changes. This S&P 500, this is the economy now, the U.S. stock market on a global basis. It is the whole global GDP in the most significant case ever. That has to stay elevated. The whole world tilts towards recession. To me, that's what crude oil is telling us. Crude oil going down and gold going up. That disparity this year, which was about 80% for a while, is the most ever, 100-year basis. And the closest example was about 60% when crude oil dropped 50% and gold was up about 10 in 2008.
Markets can remain irrational more than investors that are shorting can stay liquid or stay essentially with money before it makes you go broke. Looking at the markets, and I looked at today how it seemed like we were teetering on the S&P the last couple of days, and then you got Tesla earnings, which they missed on earnings, but they beat on revenue. And then we've seen Tesla reverse, and the S&P is literally right now at the highs of the day right now. And part of me thinks like this is based on the fact that we're going to get this magical CPI data today. The government's not giving us any other numbers, but they're giving us CPI. And I would just like to point out that the last Fed meeting, 6 days before that Fed meeting, we got jobless claims. And for some reason, so it was like 25,000 for like multiple straight reports. And then 6 days before, we got a jump to 263,000. And I still remember on CNBC and Bloomberg, a lot of the analysts were like, oh, maybe they need to go 50 basis points. And then they didn't. And then miraculously the next week, jobless claims went back to 225 or 220, right? And so part of me, right, I was just going to say, like, I can't help but think that this release 5 days tomorrow morning for CPI before the Fed, there's no way this is a hot number, like not even close. And does the market sniff that out? And that's why we're rallying.
Well, there's one thing I want to remind us to look at CPI is it's still way above target. It's expected at 3.1%. That's what I show right here. The latest reading was 2.9%. It's supposed to be down by 2 by now. But the number one reason that keeps CPI high is we have the greatest wealth effect in the history of mankind. I mean, there's bar none. It makes 1929 in the U.S. and 1989 in Japan look like silly, sissy stuff, certainly in a percentage of GDP. So that's going to keep CPI elevated. Yeah, the Fed's easing. They shouldn't be easing in that environment, but they are. That's what gold loves. But gold's already worked for it and priced it in. That's why I think that's, this is great. Just keep everything elevated. But it's the lessons you learn when what we generally expect does not occur. And Scott mentioned it. And when you see frothy stuff like this, you find alternatives. And that's why gold was a great alternative this year or for this year. Now that's even too expensive. So that's why I tilt over to that good old treasury bonds. And also you're locking in for the rest of the year. So I think that's the problem is I'm really worried about this year still, that if we just start sliding a little bit. Like I look at the Bloomberg Galaxy Crypto Index, it's still up. It's only up 5% on the year. It was up 30%. Everybody expects it to accelerate. Now, it might if the stock market goes higher, but it's been lagging for almost 12 months now. Something's happening. And that's why I look at it as a prudent risk manager. Certainly if I'm sitting at a desk with leveraged people trading gold or anything, I'm saying, okay, you're supposed to lighten up on some of that gold. Do you want a bonus? Do you want to blow, you want to give back those profits? But that's the psychology of the market now. And it doesn't stop. So that's why I just I got to back off and just say thank you. And I looking for the next trigger. That's the key thing, though, is when you get volatility this low, right here, it's just a catalyst waiting on a spark. I just don't know what that spark will be.
Gold's dominance in the global market has reached a critical inflection point. It's a sustained move far above long-term averages that signals not just strength, but exhaustion. The same forces driving this euphoria are quietly building the next imbalance. As stocks stretch to record valuations and inflation remains stubbornly high, the illusion of control begins to fade. History reminds us that when liquidity hides risk for too long, reality reasserts itself violently. The bond market, once ignored, may soon become the refuge for capital-seeking stability in a world addicted to momentum. This divergence between gold's exuberance and oil's weakness hints at something more profound, a signal that global growth is slowing even as asset prices soar. The setup resembles 2008, when calm masked fragility. The smartest investors know this is the time to protect, not to chase. Every cycle ends the same way. Confidence peaks before correction begins. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.